What's the smartest way for beginners to start investing online with just $100? I get asked this question all the time, and today I'm finally going to give you a clear answer. Setup. 4 years ago, I invested $100 into 5 different things all online, straight from my laptop. Today I'm going to reveal exactly how those investments performed, what my $100 grew into, and which method is the best for beginners in the US right now. We'll judge each one on 1. Learning curve. 2. Passive income potential. 3. Tax efficiency. 4. Risk level. 5. My real result. Quick disclaimer, I'm not a financial advisor. This is just my experience. Always do your own research before investing. 1. Individual stocks. First up, stocks owning a piece of a company like Apple, Tesla, or Amazon. Learning curve. High. Picking stocks isn't a guessing game. You need to study company financials, leadership, growth trends, or you're basically gambling. Passive income? Good. Stocks can make you money 2 ways. 1. The price goes up and you sell for profit. 2. Some stocks pay dividends, cash paid out just for owning the shares. Tax efficiency? Great. In the US, using accounts like a Roth IRA or 401k lets you grow investments tax-free or tax-deferred. Risk? High. I once threw a dart and ended up investing in Samsung. That $100 dropped to just $67. Ouch. But if I'd hit Nvidia, that same $100 would now be worth over $900. Bottom line, stock picking can pay off big, but it's risky unless you really know what you're doing. 2. REITs, real estate investment trusts. Second, REITs. Think of this like owning a slice of real estate without buying property. Learning curve? Moderate. You don't need a mortgage, a realtor, or huge capital. You're just buying shares in companies that own properties like offices, apartments, or shopping malls. To passive income? Great. By law, REITs must pay out at least 90% of profits to investors, which means high dividends. Tax efficiency? Great. Hold REITs in a Roth IRA and boom tax-free growth. Risk? Medium. Safer than buying one property because they spread money across many. But if the market struggles, your dividends can shrink. My result? That $100 became about $98 in value, but it paid me over $11 in dividends. Net profit plus 10.5%. 3. Cryptocurrency. Third, the Wild West, crypto, Bitcoin, Ethereum, digital money not controlled by banks. Learning curve? Moderate. You'll need a crypto wallet, a trustworthy exchange like Coinbase, and basic knowledge of blockchain. Passive income? Moderate. You can stake or lend your crypto for rewards, but this comes with high risk. Tax efficiency? Poor. In the US, every trade is taxable. Even swapping Bitcoin for Ethereum triggers a taxable event. No tax-free retirement accounts for crypto. Risk? Very high. Prices can skyrocket 500% or crash overnight. Scams and hacks are also a big threat. My result? $100 in Bitcoin turned into $652. That's plus 552%. But remember, that kind of growth isn't typical. 4. Gold. Fourth, gold. The original store of value. People call it a safe haven when inflation or the economy gets shaky. Learning curve? Low. You can buy gold coins, bars, or even just gold ETFs, exchange-traded funds, on apps like Robinhood or Vanguard. Passive income? Zero. Gold doesn't pay dividends. It just sits and holds value. Tax efficiency? Good. Some U.S. coins like American Eagles are exempt from capital gains tax, and ETFs in a Roth IRA are tax protected. Risk? Medium. Gold is steady, but it won't grow as fast as stocks or crypto. My result? $100 became $140. Solid plus 40% return. Slow and steady wealth protection. 5. Index funds. Finally, my personal favorite, index funds. Think of it like owning the top 500 U.S. companies. Apple, Microsoft, Amazon, Tesla, all at once. That's what the S&P 500 index fund does. Learning curve? Low. Just pick a low-fee fund, invest, and forget it. Passive income? Moderate. You'll earn dividends from hundreds of companies, plus steady growth. Tax efficiency? Excellent. Put index funds in a Roth IRA or 401k, and your gains are tax-free for life. Risk? Low. They're diversified across hundreds of companies. Historically, the S&P 500 averages 8–10% returns per year. My result? $100 grew into $179. That's plus 79%. Consistent, predictable, and stress-free. So after 4 years, here's the scoreboard. Stocks, my dart throw, minus 32%. REITs, plus 10%. Crypto, plus 552%. Gold, plus 40%. Index funds, plus 79%. The lesson, diversification wins. Don't put all your bananas in one basket. If you're just starting with $100, my #1 recommendation is index funds. They're simple, safe, and tax efficient. But if you're curious, putting a small slice into higher risk assets like crypto can spice up your portfolio. The most important part? Start now. Time in the market beats timing the market. Smash that like button if this helped you. Subscribe for more beginner-friendly investing tips. And drop a comment. If you had $100 to invest today, where would you put it?